This is Bloomberg Wall Street Week.
We may not have an overall recession. We're having a rolling recession. The economy overall looks pretty strong, at least when it comes to jobs.
The financial stories that shape our world.
3 major regional bank failures sent shockwaves through the banking system. We're all trying to figure out what to make of generative AI.
Through the eyes of the most influential voices.
Welcome now, Dr. Paul Krugman, Brian Moynihan of Bank of America, Deborah Lair of the Paulson Institute, Glenn Hubbard of the Columbia Business School.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Sometimes no news can be good news. No government shutdown, no new flare-up in U.S.-China relations, and no new surge in inflation numbers. This is Bloomberg Wall Street Week. I'm David Westin. This week, special contributor Larry Summers of Harvard on whether we're through the worst on inflation.
I'm not sure the inflation figures over the next 2 years are going to be quite as favorable as the market is expecting.
Tony James of Jefferson River Capital on the past and future of private equity and credit.
Private equity really needs to be operational as well. You still need the transaction skills. You still need to be an investor, but now you need to be able to intervene in the company's fortunes.
And Dan Senor about the Israeli-Hamas war and what it means for the Israeli economy.
They can get through the short term. I think in the long run, Israel's tech economy will be stronger.
Global Wall Street had an exciting week, mainly because of what didn't happen. President Biden met with President Xi during the APEC summit, and they appeared to set a new, more constructive tone to U.S.-China relations.
Our meetings have always been candid and straightforward. We haven't always agreed, but they've been straightforward. And today, build on the groundwork we laid over the past several months of high-level diplomacy between our teams. We've made some important progress, I believe.
The U.S. Congress got its act together and finally agreed not to shut the government down, at least until after the new year.
I have good news for the American people. This Friday night, there will be no government shutdown.
But most exciting for Global Wall Street this week were those CPI numbers that came in even better than expected, pointing to a continued slowing in the rate of inflation and maybe, just maybe, no need for the Fed to keep hiking rates.
It's a rather amazing number this morning. CPI comes in flat. The estimate was 1/10, and it had been 0.4 back in September, and that leaves the year-over-year headline number at 3.2%, down from 3.7.
And then late on Friday, word came that the man who made ChatGPT famous, Sam Altman, was stepping down immediately as CEO of OpenAI after the board lost confidence in his candor. And Microsoft shares dropped on that news. The markets overall had a nice bump up during the week with the news about slowing inflation and a strong economy. The S&P 500 was up 2.24%, ending at 4,514. That's comfortably above the median number of our Bloomberg elves that they're predicting for year end. The NASDAQ was up 2.37%, while the yield on the 10-year dropped almost 22 basis points to 4.4. Here to tell us what it all means are Saira Malik, Nuveen Asset Management CIO, and Peter Borish, Computer Trading CEO. So welcome back, both of you. It's great to have you here. Saira, let me start with you. Was it really all about the CPI numbers in the end for this week?
Well, the Santa Claus rally has come early this year for 3 reasons. One of those is inflation, which is coming in under expectations. Also, the Fed has signaled the end of the rate hike cycle. And finally, the economy, which is showing some signs of cooling, but not enough to take us into a recession. All of this caused 10-year Treasury yields to drop by about 50 basis points and markets to rally. However, I caution 2024 looks a little bit more complicated. The question is going to move not from how high will interest rates go, but to how long will interest rates stay high. And given that futures markets are expecting 4 rate cuts in 2024, I think that's optimistic because inflation is still above target and we're not in a recession. So I don't see why the Fed would be cutting rates so aggressively going into next year.
So Peter, before we get to 2024, which we do want to get to, what about for the rest of this year? Can we put our pencils down on our desks? Are we in pretty good shape for the rest of this year, do you think?
You know, in this business, a week can be a long time. Just look at the move from 2 Fridays ago to this Friday. So no, and you can never put your pencils down. And if you listen to some of the Fed talk, President Collins, they're kind of like, wait a second, financial conditions aren't really that tight. If you look at the equity markets, we may have to raise again. So I agree with Saira. I mean, I'm in the camp that I don't even think the Fed is going to cut at all next year, and that's going to make for a bumpy road. And depending on what the news conference is after the next Fed meeting, this could sort of be an upside down. Remember, in 2018, you had the tremendous rally the last week of the year. This could be the opposite of that.
Oh, really? So the reverse of a Santa Claus rally?
Well, you have if you pick any low in the fourth quarter, by definition, you're going to have a rally off of it. So, yeah, as she said, we had an early Santa Claus rally. We had a low, we rallied. But then we could have a nice little correction going into the end of the year.
So, Saira, how much of it do you think is in the hands of the Fed? We all focus on the Fed. It's understandable what we do. But it's not just the Fed that determines things like yields, for example. We've got a lot of issuance coming out of the Treasury these days. It looks like that's not going to stop anytime soon.
I think it is still very important. And what is the Fed going to do next year? Let's start with inflation, which Peter talked about, which will have to do with whether we get rate cuts. Inflation is still about 1% above the Fed's target when it comes to CPI. And that last mile of inflation could be the longest mile. Our view is that inflation likely doesn't hit target in 2024. That's going to prevent you from getting aggressive rate cuts. So that's going to be an issue for the Fed. And also looking at the economy, the consumer and employment markets have been driving the economy. Payrolls are still coming in close to 200,000. Yes, we did see unemployment claims spike to August levels this week. So employment is starting to slow. Consumers starting to show some cracks when it comes to delinquencies. But none of that means a recession is imminent. Until you get those two factors of inflation at or below target and a recession right in front of us, I don't think the Fed's going to have the room to cut rates.
But what about the equity side, Saira? Because we've had sort of I can say a subdued earnings session here. What are we looking for in 2024?
Well, Q3 marked the end of our earnings recession. Before Q3, we had 3 quarters of negative earnings. So it was good to see this growth in third quarter. And in 2024, we expect about 5% earnings growth. That'll be positive. It will be dependent on companies' ability to preserve margins as inflation continues to moderate. So that'll be the positive. I don't think we're going to see a lot of valuation expansion driving the markets in 2024 because valuations are already at a premium.
So, Peter, what about the consumer? Because the consumer really feeds directly into earnings because companies have to sell things. Where is the consumer right now? Are they running out of all that excess savings that they had?
Well, first of all, Saira made a great point, but when I look at the consumer, I kind of try to watch, Visa and MasterCard as a proxy for consumer, and those stocks have continued to stay strong, close to their all-time highs. So I think it's a little premature, given the fact that employment is still high, right? Unemployment is low. Again, another indication that financial conditions are not tight. And therefore, I think the higher probability of rates going up. So the consumer's in pretty good shape for now, but I look at the 3 C's, right? Copper, corn, and crude. And they have been weak, so that's saying something about the aggregate demand in the economy. So that's the irony of markets. They have been weak, that drags down inflation. But is that bullish?
Saira,
Peter brings up a good point, David, about the consumer. They continue to spend, and consumer discretionary stocks have been very strong this year. But if you look under the hood at the consumer, auto and credit card delinquencies are increasing significantly. I think the consumer is starting to show some cracks. And if the employment markets continue to slow and people do not feel secure in their jobs, I think that'll be the unwinding of the economy that does eventually get us into that recession. But again, as I said, that is not right around the corner.
Peter, is it too soon to get back in the pool for real estate?
Well, there was a very interesting article on Bloomberg today about how so many homeowners actually don't have a mortgage. So this notion that, well, the market's frozen because people don't want to sell because they have low mortgages, that may not be true. If that's the case and people want to trade their stock, that may increase the housing supply, and that could drive down some prices again. Ironically, is that bullish or bearish for interest rates as housing demand gets met with increased supply? So is it too soon? No, but it's going to be interesting.
Fascinating. What about?
I think an area, David, within REITs that looks really attractive is actually the public REIT sector. It's trading at a discount to net asset value. REITs actually tend to underperform while rates are going up, and in periods of rate pauses and rate cuts, REITs outperform. And I think that's what we're getting to. This elongated pause by the Fed should be positive for segments such as REITs.
Well, Saira, that's fascinating. I mean, REITs got clobbered, obviously. Do you think they've bottomed? They're going to come back up?
We've actually seen them bottom in the last couple of weeks as yields rolled over. And if you look at history, as the Fed pauses, and we don't expect any more Fed rate hikes, that should be positive for REITs. They're still cheap. They're trading at a discount to NAV. Many are worried about commercial real estate, but if you look at the main REIT benchmarks, it is a very insignificant low single-digit percentage portion of their benchmarks. Industrial REITs, apartment REITs, all of those are actually doing very well. So it's not just a commercial real estate story. That's a very small piece of REITs.
Saira, Malik, and Peter Borish are going to be staying with us. But first, we're going to take a look back at another time when we watched the Fed wait patiently for inflation to come down. Here's Frank Cappiello on Wall Street Week with Louis Rukeyser way back in 1982.
This is a whole new aberration. I think what's happening is economic policies now are more important than the statistics. And the policies are less inflation. We've really got a Federal Reserve that's fighting any recurrence of inflation, and we've got interest rates that will eventually come down.
This is Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
President Xi is desperate for American investment because he has made a series of economic decisions and political decisions, arresting people where capital is fleeing. The coin of the realm for the United States, we have allies, we have friends, and they want to be aligned with us.
That was U.S. Ambassador to Japan Rahm Emanuel talking at the APEC summit this week in San Francisco about efforts by Chinese President Xi to attract Western investment flows back into China. Saira, Malik of Nuveen and Peter Borish of Computer Trading have stayed with us. So, Saira, let me start with you. We had the meeting with President Biden, President Xi. Not a lot came out of it, except they did talk. They didn't fight with one another. I guess that's good. But overall, do you think this affects the status of investments right now, that in fact U.S. and China may be at least not at daggers drawn?
I think there's two issues to think about from this week's meeting and over the long term. One is geopolitical issues, which I think did become reduced a bit this week. You saw that with CDS spreads narrowing a bit. But the main issue with China is exports. They've declined significantly in terms of what they export to the U.S. over the last 5 years. And that, I think until they can turn that around, that's going to be an issue. And there's other countries that are benefiting from this, like Mexico with its nearshoring, the increased need for infrastructure in the U.S., which is a segment of the market that we really like. Countries like Indonesia with young populations, and Japan, which is benefiting with their weaker yen. So as China loses in these areas, these other emerging and developed international countries are winning. And I don't see that trend reversing in the near term when it comes to China's exports to the U.S.
Peter, you talked earlier about commodities. We often think about China when it comes to things like copper, for example. To what extent is the demand for copper, the price of copper, going to be determined by what happens in China and whether they can really rebound in their economy?
Well, I think a lot of that, and you could see earlier this week they laid out the objective by doing a big soybean purchase, right, which reminds us of the early 70s when you had another crisis and they came in and bought a bunch of grain before President Nixon went to China. But I think the history lesson here is that emerging countries and their markets understand that if you partner with the U.S., you get rich. Now, you've had growth and they got rich, and then they're like, okay, we don't need you anymore. This crisis in China has made them realize that if you want to stay rich, you need to partner and continue partnering with the U.S. So what Saira said is critical. And yes, so they need our capital, as Ambassador Emanuel just said. But people aren't going to fly in there. They have to demonstrate that the capital is going to be safe, that the human capital in China is going to continue to be safe. So it's going to be a little bit of a slower process. And that's going to be reflected not in immediate demand for commodities and copper, but a slow and steady demand, as Saira was saying earlier.
Saira, just briefly here at the end, what does that mean for other opportunities? For example, in China and Japan, I think you've just gotten back from Japan, have you not?
I was in Japan last week, and Japan's economy is growing very strongly for two reasons. One, the increased focus on governance, not only within the country, but from non-Japan investors. Secondarily, Japanese government is very focused on getting individuals out of cash into more investable asset classes. And second is the Japanese economy is going very strong. The yen has been weak. However, our view is with some moderate inflation that we're seeing in Japan and likely higher interest rates, I think the yen is likely to bottom and reverse from here. But that does not unwind the Japan story that has been very strong this year and should continue.
And finally, Peter, also Mexico's a lot more attractive than it was.
Absolutely, for the near sourcing, for their innovation, and again, climate change has a little impact on that because we were saying earlier that the Panama Canal is low, so Mexico is trying to build and increase their transportation infrastructure. I just want to add in 10 seconds. China, Japan, that story, that's bearish for U.S. Treasuries because they are both selling Treasuries to focus on their domestic economies. It's a globally integrated world, so you have to be careful what you wish for.
What about that? Just in a word or two, Sarah, do you agree there's a problem here with foreign buyers of Treasuries?
I think Peter makes a good point, and that could be a headwind.
Okay. Thank you so much, both of you, for being back with us. That's Peter Borish of Computer Trading and Sarah Malik of Nuveen. Israel's war with Hamas continues, with Israeli troops fighting Hamas in Gaza as the humanitarian toll mounts. Dan Senor was a foreign policy advisor to George W. Bush when he was president in his administration, and as well to Mitt Romney. He is the author of a brand new book. It's called The Genius of Israel. So, Dan, welcome. It's good to have you here.
Thanks.
Congratulations on the book. Congratulations on the fact that it's on the New York Times bestseller list, I should mention.
Thank you.
You actually wrote this book, completed it before what happened last October 7. At the same time, you were anticipating some difficulties within Israel. There have been demonstrations because of what happened with the Department of Justice. So as we go forward now, one of your themes is Israel is resilient. You've got that in your subtitle. Resilient and comes together. What have you learned since October 7 about Israel?
Well, we argued in the book, because we wrote the book at the point at which Israel is in the depth of internal division, as you say, and we argued that as divided as Israel was, it was politically polarized. And we said, look, most Western affluent democracies are very politically polarized. Israel's not immune to political polarization. The difference between Israel and other Western countries is Israel has these societal shock absorbers built into it, this like infrastructure that just as polarized as it may get, the country doesn't spin apart. And that's why we said that, in a sense, Israel's like a blueprint for the West to look at how they keep the country together, even when it looks like it's about to go over the edge. We look at the role of national military service, which is interesting because it not only, as we wrote in our first book about the tech economy, the national military, the compulsory service, helps young people develop management skills, leadership skills, in some cases specific technology skills that help them in the startup scene. But in this book we focus on the national compulsory service brings Israelis together from all walks of life, religious and secular, politically right-wing, politically left-wing, people from the center of the country, like in booming cities like Tel Aviv versus the struggling towns of the periphery. It brings all these people together and has them in the hull of a tank or in the warehouse on a military base. And they are working together and living together, and it makes it harder for them to look at one another as the other. So that's another important national compulsory service. And then lastly on national compulsory service is they focus on the we, not the me. In other words, to be effective in national military service in Israel and in other parts, formative parts of Israeli life, you have to focus on being part of a team, community, a group. And we go through this in the book and say, compare that experience to how Americans go through life, trying to get into colleges, trying to get into elite colleges. It's all about your own individual performance, your own individual excellence. There's a lot to learn from Israel in terms of these institutions that keep people together, even though they see the world differently. And that's why we were hopeful that even if there were an October 7th event, and we didn't anticipate an October 7th event, but even if there were one, it wouldn't surprise us if the country held together.
Israel has had, I think, a disproportionate effect in the global economy, given its size and its location. Is that in any way in jeopardy? The integration, certainly within the Middle East, we were hoping for really a rapprochement with Saudi Arabia.
Yeah.
That certainly is not happening anytime soon. But even more broadly in Europe, and as the rest of the world starts to be really uneasy with what's going on in Gaza.
So I think there are look, if the U.S. stays strong, shoulder to shoulder with Israel, during these next few months that are going to be difficult, I think the rest of the world will basically follow. I don't think Europe is going to go in a dramatically different direction than the U.S. That's why it's very important to Israel that it stays locked arms with the United States. And so far, that's pretty good. That all indicators are that's pretty strong. The question, to your point, is the Gulf and the Arab world. That's where the most progress was being made. Now, if you go back and look at why the Sunni Gulf, Bahrain, the Emiratis, the Saudis were in the works, as I call Israel's friends and Israel's future friends, why all that was deepening and warming was not out of love for Israel. Those countries were doing it because they believed in Israeli strength. They were betting on the strength of Israel's economy, its tech sector, as we were just talking about, its geopolitical positioning in the world, which had been growing, and they believed in the idea that Israel's military and intelligence capabilities were a juggernaut, and they wanted a piece of it. They wanted to be part of it because they shared a common enemy, specifically Iran and the Muslim Brotherhood.
Dan, it's really great to have you. I'm back on Wall Street Week. That is Dan Senor. He is the author of the new book, The Genius of Israel. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. We're joined once again by our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. So Larry, welcome back. Great to have you here. Let's start with one of the major events of the week, and that was President Xi and President Biden actually meeting around the APEC meetings out there in San Francisco. It's hard to know where this will go, but so far so good. They seem to be trying to really pull themselves back from the precipice.
Look, it's important to have meetings like this. Churchill famously said, much better jaw-jaw than bang-bang. On the other hand, I think we need to remember that there are very difficult fundamentals here. Very different systems, very different views of the world, profound competition in the technological arena, concerns on the American side about China's subversion of our vision of the international system, concerns on the Chinese side that the United States is trying to hold them down. So there are very profound geopolitical forces at play, and this struggle is going to be with us for a very long time. So I'm glad to see the meeting, but I'm concerned, and I'm particularly concerned in light of the gravity of the economic challenges that China is facing. And my concern is that, as with the Soviet Union in the 1960s, a sense of very serious economic challenges is going to drive a felt need for increasing assertiveness in the international arena, as we saw with Khrushchev's moves on Berlin, as we saw with the placement of missiles in Cuba. And while I don't see anything concrete like that that's happening right now, I think the economic distress and the link to nationalism, given some of the very strong positions that Xi has taken, is something that is going to require the United States and the West to be on their guard going forward.
Global Wall Street's paid a lot of attention this week to those CPI numbers that came out for the United States. Some people are, if not declaring victory, close to declaring victory over inflation. Are they premature?
Look, those were good numbers. Those were better numbers than I would have expected, better numbers than I think most people would have expected. And I think inflation performance has been more favorable, certainly than I have expected over the last year. And I've thought a lot about that, David, and I think there are two or three factors to emphasize. The first is that policy has been much tighter than was anticipated. In July of 2022, markets were assigning a probability of under 10% to to the level of tightness in policy that we have seen so far. So more tight policy has led to better outcomes on inflation. That doesn't mean inflation fears were unwarranted. It means that people took the fears seriously, which was good. I think that's one important aspect. I do think that given how strong the economy has been, there's still a surprise in what's happened to inflation. And that, I think, has to do in part with transitory factors that were pushing inflation up from bottlenecks that are now mean reverting and are pushing inflation down. So I think there's been a little bit of prematurity in some of the declarations of victory, and I'm not sure the inflation figures over the next 2 years are going to be quite as favorable as the market is expecting, especially in light of the geopolitical risks around oil and some other commodities. So we'll have to see whether we're really able to get down to 2% quite as easily as many people imagine. And
what is the risk right now of a recession in the first half of next year?
It's certainly under 50-50, David. I think it's probably on the order of 25% that ultimately something will happen which will cause the NBER to date a recession as having begun in the first half of the year. In general, when recessions come, we don't even know that we're in them till they've been underway for several months. So I think you got to recognize that as a real risk. On the other hand, with what we've been seeing in the employment reports, incomes are continuing to grow. So I don't think that is the preponderant scenario.
And the main issue is not even what they did this week, but the larger issue about the weight that this may impose on the U.S. economy.
If somebody's got a basic problem of being overweight, it's good if they skip dessert. It's good if they check into a spa for a weekend. But what really matters is whether they change their habits and they change their lifestyle. And nothing in this agreement or anything in the discussions currently underway is about changing the American habit or lifestyle with respect to spending and taxes. I look at the world right now, and it is the most ominous world geopolitically that I have seen, certainly since the Berlin Wall fell in 1989. I look at projections for the federal budget that call for defense spending as a share of GDP to fall substantially. I don't think that should happen, and I don't think that will happen, almost regardless of how domestic politics play out. And so I think as I look at the budget picture, we got to recognize that we've got a big national defense liability ahead of us that we're not really budgeting for in the current projections. And much more generally, David, is a very profound question of how long the world's greatest debtor will remain the world's greatest and most secure power. And so I think that everybody talks about our resilience as a country. Well, part of resilience for a company, part of resilience for a household is containing your leverage and containing your borrowing. And I think that's something we need to think about as a nation.
To continue your analogy to dieting, if you're going to lose weight, you can't just exercise, you can't just cut back on what you eat, you got to do both. And right now, one might think we have one party who doesn't want to increase taxes and increase revenues, the other doesn't want to cut spending. How did you manage in the 1990s to get over that hump?
Well, I'm happy to try to answer the question how Bill Clinton managed. I don't want to be the one taking credit for the 1993 budget deal. Look, I think he laid out the case. He brought people together. He was willing to do things that were painful for the people who were his friends. He was able to explain the case to the American people, and that's the kind of leadership we're going to need. And he reaped a benefit that I think people need to recognize and that maybe hasn't come into focus quite yet.
Okay, Larry, thank you so very much. Always great to have you with us. That's Larry Summers of Harvard. Coming up, second acts. Sometimes you win, sometimes you lose, and sometimes you end up with the cat. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Finally, one more thought. F. Scott Fitzgerald told us that in American lives, there are no second acts. The annals of business and politics and sports are filled with stories of stars who had great first acts but fell short when they tried to come back. Think Michael Jordan's ill-fated career as a professional baseball player after he had dominated the world of basketball. Or famed Hollywood agent Michael Ovitz, who left an indelible stamp on the entertainment industry with his creation of CAA, only to struggle with a transition to the corporate world under Michael Eisner. But that doesn't keep people from trying, and sometimes succeeding, all the way back to the early 19th century when President John Quincy Adams lost to his arch-rival Andrew Jackson, only to come back as a congressman, and some have suggested he had more success in that role. Or Arnold Schwarzenegger, who went from action star of the big screen to become a successful governor of California.
I'll be back.
Just within the past 2 years, we've had two notable comebacks in the corporate world, as Howard Schultz returned for a second time to run Starbucks, and he's seriously considered a second act that would go way past coffee.
I am seriously thinking of running for president.
Bob Iger returned as CEO to Disney just under a year ago and was praised by competitors like Reid Hoffman.
Bob is, I think, one of the great CEOs of our time. Part of what you want CEOs to be doing, which is acting like owners and feeling that the important thing is the legacy of the company that they hand on to their successors, to employees, to society, and I think Bob is that guy.
And even as we speak, we have Donald Trump, the 45th president, trying to come back as the 47th, vowing to make America great again.
In order to make America great and glorious again, I am tonight announcing my candidacy for President of the United States.
But perhaps the oddest story of attempted second acts comes not from America, but from Great Britain. We all remember David Cameron, that young, charismatic British Prime Minister who was so confident his fellow Britons wanted to stay in the European Union that he decided to put it to a vote. He was wrong. They voted to leave, and Mr. Cameron had little choice but to leave as well.
The British people have made a very clear decision to take a different path. And as such, I think the country requires fresh leadership to take it in this direction.
Now, 7 years later, another struggling Tory Prime Minister, Rishi Sunak, has decided to bring Mr. Cameron back. Not as Prime Minister, to be sure, but as his Foreign Secretary. Things are quite a bit different today than they were when Mr. Cameron left number 10. The world's been through a pandemic. The promises of economic prosperity made by the Brexiteers have proven largely hollow. And the polls point to Labour being back in power with the next general election.
The labor market data was also pretty positive. Wage growth decelerated a little bit. It's still incredibly high, though, and so I would put all of this in the category of good news.
But David Cameron will have one friendly face to greet him when he pays visits to number 10 Downing Street, that of Larry, the chief mouser at the Prime Minister's residence, a cat who shared the house with the Camerons back when they were in charge. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.